Welcome, curious minds, to another deep dive. Today, we're zeroing in on a true giant of the American healthcare system, HCA Healthcare, Inc., listed on the NYSE as HCA. You might not instantly recognize the name, but their hospitals and clinics are just integral parts of communities all across the country. The central question we're going to explore, really, is whether this sprawling empire's immense scale truly acts as an impenetrable fortress, securing its profits and market position. Or maybe it presents a significant vulnerability in what is, let's face it, a turbulent and ever-changing industry. Our mission is to take the sources you've provided and really delve deep into HCA's operational, financial, and strategic foundations, giving you a comprehensive understanding of this healthcare behemoth.
Yeah, and it's particularly insightful, I think, to examine how a company of this magnitude navigates an industry facing these relentless pressures. We're talking labor shortages, significant regulatory shifts, rapid technological disruption. It's a lot. So we'll analyze whether HCA is strategically positioned to thrive in the coming decade, helping you understand not just what they do, but really why their specific strategies and market position are so impactful. And just for context, all our data and analysis are current as of August 31st, 2025, with HCA's closing share price at $403.96 on August 29th, 2025.
Okay, let's begin then by unpacking HCA's core business. What is it fundamentally?
Well, at its heart, it's one of the largest for-profit healthcare service providers in the U.S. They own and operate this vast integrated network. We're talking 191 hospitals and roughly 2,500 outpatient sites that includes surgery centers, urgent care clinics, and numerous session practices.
Right. And looking at the bigger picture, how do their revenues break down?
Their revenue streams are actually notably diversified. They pull from commercial insurers, major government programs like Medicare and Medicaid, and also direct patient payments. This diversification is really key. It kind of insulates them from over-reliance on any single payer, which you see can be a major vulnerability in this sector.
Okay, and here's something I find really interesting. How they create these dense, localized healthcare ecosystems. Imagine a patient starts at an HCA urgent care, then sees an HCA specialist, maybe has surgery at an HCA hospital, all in their network. How does this integrated approach translate into that powerful local moat you hear about?
Well, that's precisely where their local strength lies. By offering a complete spectrum of care from, routine visits to complex surgeries all under their umbrella, they make it incredibly convenient for patients. That naturally fosters loyalty. And for insurers, it means HCA can negotiate from a position of real strength. They're often a dominant provider in many markets, making them effectively a must-have for insurer networks.
Got it. So that gives them leverage.
Exactly. Leverage in pricing and reimbursement rates that, frankly, smaller standalone facilities just can't command.
So given that integrated approach, how does HCA then diversify its cornerstone services? Are they just sticking to traditional hospitals, or are they adapting?
That's a good question. While the general acute care hospitals remain foundational, offering, everything from cardiology to neurosurgery, HCA has also aggressively expanded into ambulatory surgery centers, or ASCs, and freestanding emergency rooms, too. This is a very clear adaptation to that ongoing shift towards lower cost, more convenient outpatient settings. It shows they're not just sitting back relying on their hospital base.
And their scale is just immense, isn't it? Providing about 6% of all inpatient hospital services in the U.S.
Yeah, and caring for an estimated 44 million people in 2024. It's huge.
With a market cap around $94.52 billion, they're undeniably a dominant force.
And their value proposition really reflects that scale. For patients, it's about providing high-quality, convenient, integrated care within those local networks we talked about. For investors, though, it's rooted in operational excellence, leveraging that massive size for efficiency in purchasing, administration, and making the kind of technology investments that smaller players just can't afford.
Okay, let's shift gears a bit. The U.S. healthcare industry is, it's a highly dynamic and complex sector. What are the big trends currently shaping the landscape for a player like HCA?
There are several key forces at play, really. On one hand, you've got a significant long-term demographic tailwind. The aging U.S. population, especially the baby boomers, is driving up demand for higher acuity, hospital-based care. That's good for HCA's core business. On the other hand, technology is just a massive game changer. Think generative AI, machine learning. They're rapidly streamlining admin tasks, improving diagnostics. And HCA, interestingly, is partnering with Google Cloud on a healthcare-specific data analytics platform to really leverage this.
But it's certainly not all tailwinds, right? What are some of the significant headwinds they face?
Oh, absolutely. A chronic labor shortage, particularly for nurses and physicians, is a major challenge. That's across the entire industry, frankly. This drives up costs, it limits capacity. It's really a primary focus for all hospital operators right now. And then there's that ongoing shift in the site of care we mentioned, more procedures moving from expensive inpatient settings to lower cost outpatient facilities.
Which HCA is trying to address with its ASC expansion, as you said.
Exactly. They're being proactive about it.
Now, when we talk about competition, HCA seems to be in a league of its own, size-wise. Market cap 5 times Tenet, 8 times Universal Health Services, but they also compete with large nonprofits and even newer threats from vertically integrating insurance companies like United Health Group. What does that mix of competitors mean for HCA?
Well, it means they're not just fighting on one front, right? Their scale definitely helps against traditional hospital chains. But the rise of these powerful, vertically integrated insurance companies is particularly interesting. These companies are now owning clinics, even some hospitals, directly competing for patient services, so that pressure forces HCA to continually optimize its services and its cost structures while still maintaining that strong local presence.
And the healthcare sector is, of course, heavily regulated.
Yeah.
How does the current regulatory landscape, especially something like the One Big Beautiful Bill Act, impact HCA?
That's a critical point. The sector is incredibly regulated, HIPAA privacy rules, complex Medicare, Medicaid billing. It's a maze. And the landscape in 2025 is, well, quite uncertain, especially with this One Big Beautiful Bill Act, or OBBA, enacted back in July 2025. This act could significantly change Medicaid eligibility and financing, potentially shifting millions of patients between private insurance and government programs. Any shift like that would directly impact HCA's payer mix and revenue streams. So management has to be incredibly adept at navigating these policy changes.
And building something like HCA's integrated model from scratch. That's not exactly easy, is it?
Not at all. The barriers to entry are exceptionally high. Building a new hospital today, hundreds of millions, maybe even billions. Plus, many states have these certificate of need or FION laws.
Right. Those limit new construction.
Exactly. They require new providers to prove a clear public need before building or expanding. This often acts as a major barrier for new entrants, effectively protecting incumbents like HCA. And beyond just the buildings, a new entrant needs to build deep physician relationships, negotiate with all the insurers, establish community trust. That can take decades.
Okay, so with all those challenges and barriers, what really gives HCA its competitive edge? What's its economic moat that protects the business?
Well, one foundational strength is actually how they manage their brand. HCA Healthcare is the corporate name, sure, but their real power comes from their portfolio of highly respected local hospital systems. Think Mission Health in North Carolina or HealthOwn in Colorado. This kind of decentralized branding fosters patient trust and physician loyalty within communities. It achieves a local connection a generic national brand just couldn't manage.
And you mentioned scale before. This seems like a huge part of it. Their supply chain subsidiary, Health Trust Performance Group, it's one of the biggest group purchasing organizations, right? How does that work in practice?
It gives them immense leverage. Basically, they negotiate highly favorable pricing on everything from medical supplies to pharmaceuticals. Think about it, buying for nearly 200 hospitals and thousands of outpatient centers. They get discounts smaller systems can only dream of. And then their Parallon subsidiary centralizes administrative functions like billing, HR, spreading those fixed costs over a vast revenue base. That directly translates into superior profit margins.
And connecting this back to the local picture, you mentioned a network effect. How does that play out?
Right. So as more facilities and physicians join their network in a specific area, the value of that network actually increases for everyone involved. Patients get integrated care, doctors get a robust referral system, even insurers find contracting simpler. This creates really high switching costs. It makes it very difficult for patients or even doctors to leave the HCA ecosystem once they're in it.
Beyond just scale, they also have some truly unique assets. Can you tell us about those?
Yeah, one really compelling detail that stands out is their ownership of Galen College of Nursing.
Ah, right. In this era of staff shortages.
Exactly. It provides HCA with a direct internal pipeline of well-trained nurses. This significantly reduces their reliance on expensive contract labor. It's a kind of structural solution to the industry's biggest headache right now. And then there's the Sarah Cannon Research Institute. That's their oncology research arm.
A leader in clinical trials, I understand.
A global leader, yeah. This doesn't just boost HCA's reputation and attract top oncologists, it lets them provide cutting-edge cancer care. Plus, their vast clinical data repository, which they're now leveraging with that Google Cloud partnership, that gives them a data-driven advantage for improving patient outcomes and efficiency. That's going to be incredibly hard for competitors to replicate.
Okay, let's turn to the people behind the operation. What's the management like at HCA? How has their leadership shaped the company?
Well, HCA is led by a very seasoned team. The CEO, Samuel N. Hazen, he's a 41-year company veteran.
Wow, 41 years.
Yeah, that kind of long tenure provides just unparalleled institutional knowledge and ensures a consistent long-term strategic vision. Their crisis response capabilities are also quite notable, actually.
I remember reading about that. During COVID, they treated more inpatients than any other system. And the response during the 2024 hurricane season, flying in hundreds of staff, how they managed that.
That's a great example, and it really highlights a key benefit of their scale. That ability to mobilize national resources for localized disasters is a direct outcome of their integrated network. They maintain local leadership with strong community ties, definitely, but the corporate infrastructure allows them to deploy resources rapidly where needed. It makes them incredibly resilient. And it's worth mentioning, the company has been recognized as one of the world's most ethical companies for 15 consecutive years by Ethisphere. That speaks volumes about their ethics program.
So with strong management, consistent performance, how does HCA allocate its capital? Where does the money go?
Their strategy is very disciplined and clear. Priority one is organic growth. They budgeted about $5 billion for capital expenditures in 2025. That's for expanding capacity in high-growth markets and continually upgrading technology. Their M&A strategy is more opportunistic. They focus on tuck-in deals that strengthen existing networks, like the Mission Health acquisition in 2018 or buying Galen College of Nursing in 2020. And they also divest underperforming assets to keep the portfolio optimized.
And they're pretty aggressive about returning capital to shareholders too, aren't they?
Very much so. They repurchased over $5 billion in stock in just the first half of 2025. And there's another $5.7 billion or so authorized. They also maintain a stable, growing dividend, increased it by over 9% to 72 cents per share early in 2025. That's their sixth straight year of dividend increases.
The payout ratio is low.
Very low, yeah. 11.47%. That indicates strong support for future dividend growth. There's plenty of room.
Okay, this brings us to a crucial metric. Return on invested capital, or ROIC. What does HCA's ROIC tell us?
Yeah, this is really interesting. One compelling detail is HCA's consistently impressive ROIC. It was 15.24% for the 12 months ending June 30th, 2025. That basically means they generate over 15 cents in annual operating profit for every single dollar of capital invested in the business, which is significantly higher than their peer group.
And that drives cash flow.
Exactly. This high ROIC generates billions in excess cash flow, which directly fuels that aggressive share buyback program we just talked about. Now, it's important to note, this strategy has actually led to negative shareholder equity on the balance sheet.
Which can look alarming at first glance.
Right, it can, but it's a direct outcome of their efficient capital allocation specifically. Buying back so much stock, not a sign of financial distress. Think of it like a highly profitable business that reinvested in itself by buying its own shares, shrinking the equity book value, but the underlying business remains strong and cash generative.
Okay, let's dive deeper into those financials then. Market cap around $94.5 billion. How's the revenue growth looked?
HCA has shown really robust and steady top-line growth. Their 5-year compound annual growth rate from 2020 to 2024 was about 8.2%. Revenue hit over $70 billion in 2024 and about $72.7 billion for the trailing 12 months ending mid-2025. That consistency, despite industry challenges, is impressive.
And profit margins. How do they hold up in such a capital-intensive industry?
They consistently demonstrate excellent operational efficiency. Their operating margin for the trailing 12 months was 15.24%. That's been consistently in the, say, 14% to nearly 17% range over the past 5 years. And their net profit margin was 8.21%. So over 8 cents of pure profit per dollar of revenue. It shows they're not just growing revenue, they're converting it efficiently into profit.
And our sources call them a prodigious generator of free cash flow. What's that mean for their financial flexibility?
It means they have a lot of options. Free cash flow has shown a clear upward trend, reaching a really impressive $7.29 billion for the trailing 12 months ending mid-2025. This significant free cash flow is the financial engine that funds everything: their capital spending, debt reduction, and crucially, those aggressive share buybacks.
Their earnings consistency is also remarkable, isn't it? A 10-year average annual EPS growth of nearly 18%.
Yeah, growing from about $5 a share in 2015 to almost $24 TTM as of Q2 2025. That's strong compounding. Now, regarding financial stability, while that traditional debt-to-equity ratio isn't very meaningful because of the negative equity.
Right, from the buybacks.
Exactly. Their debt-to-EBITDA ratio is around 3.05x, which is generally considered manageable given their stable and predictable cash flows, and their current ratio is bent 0.98. It's just below 1.0, but that likely reflects aggressive cash management and strong access to capital markets, not really any liquidity issues.
Okay, turning to valuation. How does the market currently price HCA?
So as of late August 2025, HCA trades at a TTM price-to-earnings ratio of about 16.97 to be precise. Now, this is a significant premium compared to its own 10-year average PE, which was closer to 13. And it's also a premium compared to peers like Tenet Healthcare, around 11.6, and Universal Health Services, down near 9.4.
So the market sees higher quality or growth there.
That seems to be the implication, yeah. The market values HCA for its superior quality, its strong competitive position, and its growth prospects.
Now, for understanding fundamental worth, we often look at a discounted cash flow or DCF analysis. What does that kind of model suggest about HCA?
Right, that's a critical question for many investors. What's the intrinsic value? A DCF model tries to estimate that by summing up a company's expected future free cash flows discounted back to today's value. Now, doing a full proprietary model is beyond our scope here, but an educational DCF model we looked at from AlphaSpread suggested an intrinsic value of around $501, maybe $502 per share.
Okay, $502 intrinsic versus around $404 current price. What are the key assumptions that drive a model like that, and how sensitive is it?
Good question. Key inputs are things like the cash flow growth rate. That's often based on company guidance, like HCA's projected 3-4% emissions growth. Then there's the discount rate, usually the weighted average cost of capital, or WACC. It factors in debt and equity costs. For a stable company like HCA, that might be in the 7-9% range. And finally, there's the terminal value. That estimates the company's value beyond the explicit forecast period, maybe using a perpetual growth rate of, say, 2-3%.
And small changes can swing the result.
Oh, definitely. Small changes in any of those growth rate, discount rate, terminal rate can significantly impact the final intrinsic value estimate. It's very sensitive.
Okay, moving to market sentiment. What are the professional analysts saying about HCA?
Well, the consensus from 39 analysts is a buy, which sounds positive, but the average 12-month price target is $396.29. That's actually slightly below the current price of $404. So it implies that while analysts are bullish on the underlying business itself, they might see limited immediate upside in the stock price from where it is right now.
Although recent news seems quite positive. Strong Q2 earnings, raised guidance, that 15th world's most ethical companies recognition.
Exactly. And the market indicators seem to reinforce that more positive view. Short interest is exceptionally low, 2.48% of the float, much lower than peers. That indicates very little bearish sentiment from short sellers betting against the stock. And the stock price itself is showing strong momentum. It's trading well above both its 50-day and 200-day moving averages. Those are generally seen as bullish technical signals.
Now, let's explore who the real believers are behind the scenes, maybe shaping the long-term direction. Who actually owns HCA?
Institutional ownership is very high, about 64%. Big names like Vanguard, around 6.6%, and BlackRock, about 5.5%, are the top holders. That signifies HCA as a core holding in many large diversified portfolios, pretty standard for a company this size. Insider ownership is around 1.4%, which helps align leadership interests with shareholders. Most insider sales seem to be prearranged 10b5-1 plans.
Right, those are scheduled sales for diversification, not necessarily a bearish signal.
Precisely.
But there's a standout feature of HCA's ownership, isn't there? A highly concentrated stake.
Yes, this is quite fascinating. Hercules Holdings II, LLC, which is an investment vehicle representing the Frist family who founded HCA.
Ah, the founders.
Right. Along with private equity firms, KKR and Bain Capital, they own a massive 29.5% of the company. This group has unparalleled institutional knowledge, and their decision to keep such a substantial investment for over a decade after the IPO, that signals a deep belief in the company's long-term value. It also provides a very powerful governance mechanism, ensuring a focus on enduring value creation, not just short-term results.
Okay, every giant has its strengths and weaknesses, opportunities and threats. Let's maybe look at HCA's SWOT, not just as a list, but as a strategic landscape. What are the key strengths that stand out?
Okay, strengths. You have market dominance, unmatched scale, strong local brand equity in their communities, that proven management team we discussed, robust free cash flow generation, and unique strategic assets like Galen College of Nursing tackling labor shortages head on.
And the flip side, where are the weaknesses?
Weaknesses. Well, they do carry a very high absolute level of debt. That could become a burden in a severe economic downturn. And as we discussed, that negative shareholder equity on the balance sheet, while explainable, can be off-putting for some traditional investors. Also, there's a high geographic concentration in states like Florida and Texas. That makes them inherently vulnerable to natural disasters. How do they mitigate that concentration risk?
That's a fair point, especially thinking about hurricane seasons. Their ability to mobilize resources across facilities helps, like we talked about, but it doesn't eliminate the risk entirely. Okay, opportunities. What growth avenues look promising for HCA?
Opportunities. The big one is the aging U.S. population. That's a major long-term demographic tailwind ensuring sustained demand. Then there's continued organic growth by expanding existing networks and leveraging their vast patient data with AI partnerships that offers significant potential for efficiency gains and improved patient outcomes. Plus, HCA is just really well positioned to gain market share from smaller, weaker competitors who are struggling with scale and capital constraints.
And finally, the threats. What looms largest for HCA?
Threats. I'd say the most prominent is regulatory risk. Any major changes to Medicare, Medicaid, or the Affordable Care Act, particularly after the 2024 election, could have a huge impact. The persistent labor shortage and related wage inflation will continue to pressure profit margins. That's not going away quickly. Increased antitrust scrutiny could complicate future acquisitions, making it harder to grow that way. And of course, competition from non-traditional players, those insurance companies moving into care delivery, tech firms, that remains a constant factor they have to watch.
Beyond the immediate industry, what about broader macroeconomic factors that could pose a threat?
Definitely. Inflation is a direct concern. It increases costs for salaries, medical supplies, everything, really. That pressures margins, even with HCA's negotiating power on reimbursements. Interest rates are another key variable. With over $44 billion in debt, higher rates mean higher refinancing costs, and that reduces the free cash flow available for shareholders or reinvestment.
And even geopolitics can play a role, right? Like tariffs.
Yes, absolutely. The imposition of new U.S. tariffs in 2025, particularly on goods from major manufacturing hubs in Asia, that poses a direct threat to HCA's supply chain. It increases costs for essential medical supplies and devices. While Health Trust, their GPO, works hard to diversify sourcing, a really broad tariff regime would likely lead to higher costs for the company, and those costs could eventually get passed on to insurers and ultimately to patients.
So wrapping this all up, what does it mean for HCA Healthcare? I mean, the sources paint this picture of a dominant, best-in-class operator, right? A deep, defensible economic moat, consistent financials, proven management, and those unique assets like Galen College seem to give them a real structural advantage in tackling huge industry challenges like staffing.
Right. But this encourages some critical thinking, doesn't it? The primary risks HCA faces seem largely external and, frankly, unpredictable. You've got regulatory changes, that high debt load if there's a severe downturn, and a valuation that currently trades at a premium to both its own history and its peers. Now, while that educational DCF model suggested an intrinsic value up around $501 per share, indicating a potential discount from the current $404, well, that's still an estimate based on assumptions that could change.
So the investment decision for you, the long-term, business-focused investor, really hinges on whether you believe HCA's powerful advantages are enough to justify that premium valuation, and whether they can allow it to keep compounding value despite those ever-present regulatory and macroeconomic headwinds. It really encourages you to reflect on how a company with such immense scale adapts and thrives in an essential but undeniably volatile industry.
Yeah, understanding that interplay between their internal operational excellence and these external pressures is really the key to grasping their position in the market, I think.
Well, thank you for joining us on this deep dive. We hope this has given you a clearer, more informed perspective on HCA Healthcare and the incredibly complex world of the U.S. healthcare industry. We encourage you to reflect on these dynamics. How do truly massive, essential businesses like HCA balance market leadership with the constantly shifting demands of policy, economics, and ultimately human need? What stands out to you? Disclaimer. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.